Hello, my name's Sam Walter. I'm from Lifetime. I'm a financial advisor. I'm actually a certified financial planner. It's my privilege to host you this evening just to talk about the Foundation Life Scheme of Arrangement, because I assume those members, people attending this, have got a policy with Foundation Life. It's my pleasure to also introduce to you Rebecca Harris. Rebecca is a senior associate at Cavell, a Christchurch law firm. And Rebecca, you work exclusively really in trusts and estates.
Yes, that's
Um,
correct.
yeah, and why do you think that that's appropriate when we're talking about life insurance?
Well, from my point of view, life insurance is a major tool we use in estate planning. So it's really important that it's done properly and it fits in with what you're trying to achieve in your estate planning goals.
Excellent. Yeah, and I can attest for Rebecca's knowledge in this area. I have been working with her recently and seen her prowess in this area. And also, I can tell she's had plenty of very interesting stories. We're going to touch on this a little bit, but both Rebecca and I have had instances where life insurance policies were owned by ex-husbands or ex-wives, and the money certainly didn't go to the right place in my
Mhm.
case, and I think it was the same for you, Rebecca.
That's correct.
Yeah. So unfortunately, paperwork can be painful to some people, but it becomes very important, especially when you pass away. But just a little note, why are we doing this? Some of our clients and some of the people calling in will be our clients have these policies. But we also are aware that there's actually 26,000 policies on issue from Foundation Life. And we're just really conscious that there's a lot of New Zealanders out there needing to make a major financial decision. And access to financial advice is limited in New Zealand and also to legal advice. So it's sort of us giving back a little bit with some basic information. It's probably a good time just to touch on my disclaimer. And Rebecca here, we have to just give, unfortunately, general advice at this point, but both our offices are always open and keen to give you personalised advice if you feel that that's required. And always that personalised advice is better because we can consider your specific circumstances. So unfortunately, today is going to be a little bit general in nature. And there is a lot of information here. We're not trying to take your money in any way. We're just trying to help a whole heap of Kiwis make good decisions. At Lifetime, we talk about creating financial certainty and making a good decision here with this policy and this decision that you have to make before the 14th of August can help with some greater financial certainty. So, what we're going to do is just give a little bit of background. Uh, where are we now and how have we got here with why is this a thing that I have to look at? Why is the insurance company asking me to make this decision? It's some important things that you need to understand before you make any decisions. Once you understand that, you can then move on to making your decision with the four options that are open to you. Then we'll just do a little bit of housekeeping and logistics, and we've already had some questions in that we might be able to deal with right at the end, depending on time. So just a little bit of a précis of how we've got here. It's now called Foundation Life, but it actually started its life as the Government Life Insurance Office. It was one of the first insurance companies, if not the first insurance company in New Zealand in 1869, and traded under Government Life all the way through down to 1987. In fact, in Auckland here, we have a Government Life building, and I've walked past that a bit. In 87, it got rebranded under Tower Corporation. And then what happened is Tower went through a very checkered sort of history, or not checkered, but different management, different offerings they did. And what they did is they separated out the traditional old policies that Government Life offered and put them under different companies. So it was called Climax Investments Limited, then Tower Life New Zealand Limited. But in 2014, it was acquired by Foundation Life and still offered policies through once it was rebranded to Foundation Life New Zealand Limited. So it might have been, hopefully, some people on this policy actually bought their insurance policy as a government life policy. That would be awesome. I'd love to meet you. Or you bought it as a tower policy. And as everyone always tells me with insurance companies just love changing their names. And so it does make for confusion. So then what happened is the scheme moved along for a while, but in 2000, they decided that it was no longer possible to keep offering these schemes. So what I've actually uh, need to explain to you is a little bit about how we got here. What happened was the type of policies that were offered by uh, Foundation Life were older schemes that were a combination of life insurance and cash value. Now, up until about 1984, it was possible to actually deduct the premium on your insurance policy. And before the 2000s, there was really no unit trusts. So Kiwis were able to get a tax deductible, and they'd get about $500 a policy back on these insurance policies. So that's why often you'd find a lot of people have lots of smaller policies to get the maximum tax deduction. But also, too, what you would do as soon as you had a child, you would also put a policy on them. The other really great advantage of these policies is they used to increase the amount of insurance they had over time. And so you would always end up with more. However, those of you old enough on this call to remember, the 1980s saw a period of very high inflation. So somebody that took out a policy in 1975 for $30,000 to cover their mortgage thought that was more than enough life insurance. But by 1990, $30,000 really didn't cover the cost of anyone's mortgage because we saw the increase of inflation, the value of the dollar go so much. So people thought they had enough insurance, but in fact didn't. And that really saw a transition without this tax deductibility to what we call term life insurance. And term life insurance doesn't have an intrinsic cash value. So there is no value in your term life insurance, but the policies sold by Foundation Life or looked after by Foundation Life do have cash value. Very different type of policy, can be a bit confusing. They separate into two different types of policy, and you need to understand which you have. The first is a whole of life, as the name implies. It should exist until you die and when you get the money back. Okay. Now, some people said, "Oh, I didn't want that money back when I died. I don't want it to go to my children." Rebecca, you might come across some people with with estate planning like that, but others were happy to leave it to their kids. But others would say, "No, I need the money when I'm 70 or 65." So what they would do is they'd call what's called an endowment policy. So they would actually have this cover all the way up until a point at which it would expire, and then they would receive some cash value back. Okay, so unlike foreign general insurance, like your house or your car insurance, where there is no cash value, these older policies did have some cash value. They would collect your premium and they would put some of that money to paying for the insurance part of the policy, and then they would invest some of that money for you. However, back in 2000, what happened was the by the time we got to that, people were investing overseas through managed funds. We grew massively in managed funds after the 1987 stock market crash in New Zealand, and people realised how much more important it was to be diversified and have their money spread across a number of investments. And they also were able to become more global investors, not investing in New Zealand, having learnt from the dangers of the 1987 crash. So they were looking more and more at managed funds for investing, not insurance policies. And they were needing these term insurance policies because they were less expense. And so the continuing buying of these older policies was not enough to support an insurance company because, as you might anticipate, you need a lot of people paying a little bit of money for insurance to work. And if people stop doing that into an insurance book, then unfortunately the cost of people dying is borne by too fewer people and it doesn't provide enough of a return. And the real cost of an insurance company is actually bringing on new clients, getting out there, marketing, giving insurance companies, salespeople commissions. That was something that Foundation Life said, let's look after our existing clients, let's keep their money invested, and let's keep a policy in place. So that's been going on for 25 years now. But Foundation Life reached out to a lot of their policy holders and were finding that people were not needing these policies as much. They were wanting to get some cash out of it, or a lot of them had even forgotten about it and weren't looking at it. And they were also concerned about the cost of running the company and giving the policy holders a fair return. I think they should be commended for going down this path and considering what they were going to do with the scheme and to go into the work of creating a wind up of this. There's a lot of work that's gone into it. And I think personally from afar have done an excellent job. So what they've had to do is consult with policyholders and give them a solution that they might find palatable. And it's really hard. What do they say? You can't please all the people all the time. So they're trying to please some of the people some of the time. And I think they've done an excellent job here. And that's well reflected in the amount of people that have voted for this arrangement that has been put out to you and suggested to you. Overwhelmingly supported. 96% of those people voted in favour. So most of you will have had a letter like this. And we've just blanked out, obviously, this person's details. But what they're doing is they're saying, look, we have had the scheme accepted and we're going to go ahead with the scheme's proposal. Now, you have till the 14th, as I said, to make a decision. And if you don't make a decision will be made for you. Okay, so what we need to do is we need to understand those options, and we're here today to help you do that. The big thing that I've highlighted here, and you need to look on this letter, hopefully most of the people attending have this letter, is what are your policy details in scheme options document. That is where this first letter here is a general letter. This next letter is where is the details specific to your case. And I'm going to show you how to use that specific information to help with your decision making in a moment. Okay, before we go any further, let's go for some important things to understand though. Okay, you may have received multiple letters or multiple schedules because you need to understand how many policies you have. You will vote for each policy and the outcome of that each policy. So if you have multiple policies, you have options to understand. But you also need to understand the other important aspects is who are the lives insured versus who owns the policy. Okay? And Rebecca's going to point out the difference in that and the importance of understanding that as well. Okay? Now, who owns the policy? Some people, we've seen over years is banks still own the policy, right? Which can be very problematic when it comes to a time of claim. And it's very hard often to try and get them discharged. I have pointed out later, you are able to transfer the ownership of these policies, okay? And we can help you do that. And so it's really important that you get that ownership right. Then secondly, you need to understand whether the policy is an endowment policy or a whole of life policy, because which one it is has a very big impact on when you get the money and how long the life insurance lasts. So if you don't know this information now, please make a note and we can send you the slides or whatever of getting that information to be able to do it, okay? Then get your policy numbers and the scheme options, and then we're going to go through and say who they are. Now, the reason it's so important is if you pass away, where do you want the money to go versus where is the ownership? And that's enough from me. Rebecca, can you explain what people might be considering with an insurance policy or even the ownership of the cash?
Yeah, absolutely. So I think the first thing, which you've already mentioned, is the importance of understanding how your life insurance policy works, who the owner is versus whose life it insures, and whether the ownership of that policy is in the name of an individual or if it's owned jointly. So if a policy is owned jointly, if one of those owners pass away, then the survivor will receive the proceeds of that policy outside of the deceased's will or their estate. So we have many clients using life insurance policies, like I said earlier, as a part of their estate planning. So, for example, they may want their the proceeds of their life insurance policy to benefit children, benefit children from a previous relationship. But if that policy is owned jointly, or is owned by the surviving partner, then it does not form part of your estate and it does not is not dealt with in your will. So it's really, really important that you have an understanding of the policy and how it is owned and who the beneficial and whose life it insures. The fact that you're all here today and have these policies tells me that you've put some thought into your estate planning. So I don't think I need to really um, badger you to have a will, but it's important to understand that there are instances where a will can be revoked. So the first, what's really interesting is your will be revoked if you get married, unless the will was made in contemplation of marriage. A lot of people don't know that. So if you have a will and you've gotten married since signing it, you no longer have a will unless it was made in contemplation, and it says that in the will. Ironically, getting divorced or separated doesn't revoke your will, but it does revoke any benefit that was but being divorced, sorry, does revoke any benefit of the divorced partner or spouse. uh, Separation does not affect your estate. So if you separate and don't divorce, or terminate your civil union, then your partner, your ex-partner, can still benefit under your will or intestacy if you don't have a will. So if you know anyone going through a separation or going through a separation, it's really important that your will is updated. And like I said, these policies can exist outside of your will or your estate. So it's really important that if you've got life insurance policies, that those are updated also. Um,
Rebecca, on that one, so I don't mind it. I know we're getting recorded here, and
yeah.
my children all know that my daughter is by far my favourite. So if I co-owned my insurance policy with my daughter, she would get all the money, and there was nothing my
hmm
son could do about it, isn't it? Even if I
hmm
said in my will 50-50 to my son and daughter, that's the way to just look after my little princess.
Yeah, absolutely, absolutely. And so we use it a lot in, for example, with farm succession planning, where one child might receive the farm, and so you might have life insurance policies so that there's cash assets for the other beneficiaries. And it's one way that you can prevent claims against your estate because it doesn't form part of your estate, so it's an asset that can't be claimed against in an estate claim. Um, yeah.
So, Rebecca, you're very good at not promoting yourself and needing to come to see you, but I will for you. Um, I would encourage anyone. It's a horrible thing to think about your passing, but I've witnessed a lot of people, my clients, pass away without having prepared ahead of time.
Mm,
And preparing ahead of time not only saves you a lot of money with lawyers, but it also means for
yeah.
a better outcome for everyone. So I really encourage anyone on this call to really think about how they can manage things as easily as possible, but also in line with what they want. And it's a
Mm,
great time when you've got this additional money that's either coming to you or an insurance policy coming to you in a different format that you don't have to pay for anymore, to really think about that. Like, this might be the best way to fund your funeral. You might
mm.
just say, look, I'm going to use this insurance to fund my funeral. How much is your funeral going to cost? I bet people often underestimate that. Would they not, Rebecca?
Yeah, absolutely. The other thing to think about, if you're at a certain age and your health is maybe not the best, if you're going to be going, if there's a possibility you may need long-term care in the future, just be aware that if you're about to receive a large sum of money, it could impact your ability to be eligible for a residential care subsidy. So for people who go into care, um, it's means tested. So the government will pay for your care if you've got assets below a certain threshold. That threshold increases each year, and it's either currently it's either $190,000 if you have a partner, and that excludes the value of your house because the partner would have to remain living in the house. So it's assets outside the house. Or if you don't have a partner, or if your partner is also in care, the total amount of assets you're allowed to have is 290,000 approximately. It's an approximate figure. So there's something to think about if you're going to be going into care and you're about to, if you choose to take the cash, that could impact your eligibility. Um, and it's not a yes or no answer on a subsidy. If you do use funds and get your cash assets below the threshold, you can then reapply. But it's just a consideration.
Excellent point. Excellent
Yeah.
point. And that actually also makes me cognizant of the fact that this amount is a capital sum that you will be receiving if you take the cash option. It is not taxable income. So, to Rebecca's point, it is considered as part of your assets. It's not considered income, so there's no tax payable or any requirement there. And if you are on some sort of benefit too, it's not considered as part of that. Amount either. But again, when you get into those areas, really important to probably get personalized advice. And I think Rebecca's made a really good point there is you don't know what you don't know, do you? So sometimes it's always good just to check that there's not something else you should be thinking of.
Right. Yeah.
Okay. So yeah, if there's one thing you write on your to-do list now is also do what we call estate planning. So start with the end in mind and everyone will be happier for it. Flows quite nicely into the four options and how we can help you choose between those four options. Hopefully you saw this in the paperwork that you've been receiving. Basically, there's two major options and then variations of those. Okay, you can choose to simply replace the insurance component of the policy with a Chubb Life policy. Had some feedback in the field from the team that people were worried about who's Chubb Life. Chubb Life's actually existed like Foundation Life or the insurance book under many a number of names. Actually, it goes way back out to actually a company called it was started by Naomi Ballantyne before Partners Life. It was owned by ANZ. It is a very robust, large insurance company. Even though they've just gone under a rebrand and been used by Chubb Life, they are a very resilient and strong rated company. So there should be no concern. At Lifetime, we recommend them as one of our providers on some of the covers, and especially for life cover. We have total confidence in their ability to meet the obligation. You're not certainly losing anything by that. And then the other extreme is that you simply take cash, an amount. And I saw we had a question earlier a little bit about how do I know the amount they've told me is going to be here. We have to trust, and we see a lot of this of estimations from insurance companies in the past that they have followed and that legal requirements the High Court's done, that they've followed a robust process. Now, they have assets, okay? The company has assets that back your policies. So they look at the value of those assets, and those are predominantly fixed interest assets. They divide it by the number of policies and yours, and they say this is what we expect it to be. Now, it's not like they're invested in Bitcoin, okay? They're not going to double overnight, but neither are they going to fall by half, okay? They're in fixed interest bearing investments. Now, it will vary by 3 or 4%, no problem. And they don't know how many people will be contactable or how many people will take what option. So they can't be totally accurate in those amounts, but I wouldn't expect a massive variation from those amounts they've quoted. But importantly, there's a ratio between the life cover they offer, up to 1.05% of life cover, and that cash payment. So then the other two options, which is an emphasis on insurance, 2/3 insurance, 1/3 cash, and 1/3 insurance, 2/3 cash. So we've got a process here I'm just going to talk you through to help you, but also you can talk to a lifetime advisor and look at your specific circumstances if required. The first and most important question is, do you need insurance? So at Lifetime, we talk about an insurable interest or bridging the gap. So if you were to pass away and you had dependents reliant on your income, life insurance is a great way to replace that dependent income. Okay. Now, the average age of these policyholders may have got to retirement and they may even be living off their assets. Okay. So that's a really important question is, do you have an insurable need? Now, the second insurable need, which I think Rebecca talked a little bit about, is do your kids actually will get benefit? Are you going to leave money to your kids? And is it better to leave it via this policy as opposed to by cash? And or could you use this policy as a way of purchasing it? Or is it a good investment for your children? So do you need insurance is your first question you should always ask yourself is there a risk? If there's some debt and you need to pay that debt off, life insurance is a great way to do it if you're relying on future income. Okay. Now, the other option is completely the second way is, do you need capital? Have you done a retirement plan and found out that your money is going to run out sooner than you run out? Okay, that's unfortunately what does happen for a lot of people. You do need a large amount of money to support superannuation if you're spending more than the 20 to 40,000 dollars for a couple that you get from the government. Okay, so a lot of our clients, we are helping them catch up, and be ready to have a little bit more. It's very hard, and especially in a major centre, to live off New Zealand super alone. So if you're needing additional capital, it might be that you have to actually use this cash to fund your future life as opposed to helping your kids out when you pass. Okay. There is a key issue here, and I checked in the information you went out. There is what they call a terminal illness benefit when you buy the life insurance. So you can get the life insurance if the doctor says you've only got 12 months to live. Okay, so it can be a really great use of life insurance in the last part of your life if you're having an illness to help support with those costs. Okay, so really think hard about that. Perhaps even do some estate planning, perhaps even do some retirement planning to truly answer those questions. Now, I'm not suggesting you cash up your policy if you're heading off to the mountain to go skiing. Skiing is what I call spending kids' inheritance. Okay, life insurance is great for helping out the kids and handing over a good start in money, but I don't know, when my parents die, I'm hoping I'll be in my 50s and 60s. And so by that stage, I'm thinking about my retirement, right? So sometimes I say to my clients, it's better to give with a warm hand than with a cold, right? And so, or if I'm sure you talk to my parents, they're like a little, oh, I don't think I can swear, but he's had enough from us. I'm going to enjoy that money. Okay, so that's an important decision to make. But what it does is it makes an important decision when it pertains to this decision. Because if you decide you're better to have the capital, then what happens is this insurance, that decision's made for you, you take cash. Because if you need to enjoy the money and spend the money, not your estate or not when you're terminally diagnosed, then it's simple, you take the cash. Now, fortunately, you might be in a position to take a few of them. Okay. That's the final bit is, are these policies for your estate and you're going to pass it on to your children? What then becomes is, what is the best investment for your estate? What's going to give the kids more money? Okay. Now, we've got an example straight away. I think probably we should move to that, which will illustrate it better. Kindly, a client has shared this with us, and basically down the bottom here, this is hopefully familiar to you with your different amounts. It's a whole of life, not an endowment. So that means the life insurance that they're prepared to give this client, which is $5,000, would last until that client died. So the client's estate would get $5,000, okay? Or they could take cash now. Now, obviously, if this client was to pass away on the 12th of December, the estate is far better off with $5,000 than they would have been with 3,292. Okay. This is a simple financial calculator sourced on the internet. You can look at that address if you want. This is simply what we did is I said, well, how many years if I earn 6% on my investment? Come talk to us if you need a return in that sort of realm or even higher. If I had $3,292, I invested at 6%. I didn't add any more money. How long would it take till it got to $5,000? And here's my result. It would take 7.173 years. Okay, so easy solution. I just tell this client, when are you going to die? They tell me exactly when they're going to die. It makes it much easier. They say 12 years, in which case I say, well, for goodness sake, take the money, give it to us to invest. We'll earn 6%. And in 12 years, your estate will have more than $5,000. Okay. However, if they say, Sam, I'm struggling to make it to tomorrow, let alone 12 years, then the life insurance becomes more appropriate. Obviously, I'm sorry I'm being a little bit light, and please, I hope it's not meant to be insensitive, but this is seriously what we have to do. And if you're unable to do it, we can always use life expectancy tables, and we can even massage that. That's a pretty intimate conversation. I'm sure Rebecca has plenty of those sort of conversations with people all the time. And when we do that one-to-one, we'll do that with the utmost respect, obviously. But that is actually the process that you need to follow to find out what is the best investment. Now, again, coming back to the other points back here, where we can actually choose a combination of the two. If you look at that calculation for you, then you might want to hedge your bets. Okay, so if you're looking at it as an investment, then you might want to say, okay, well, we think it's an investment. I think 7 years is a bit difficult, but I might. Well, then that might be a good option to take 2/3 cash, invest that, and a third later. Okay, so just going back to my 4 points, if you need the insurance, you keep it all. If you need the capital, you take it as cash. But if you're saying, no, this is for my kids, then you still need to calculate what's better for your kids, investing the money or keeping the money as life insurance, or do we a combination of both? Hopefully that makes a little bit of sense. If not, we can always deal with that with you one-on-one, as I said. So now some logistics. You remember you do all your voting online. So look to do that voting. You can do it online, or you can post back your application, whichever you're more comfortable with. I was talking to someone that had done it online just a few days ago. They said it was very easy and simple for them. Obviously, everyone's different computer skills. They are still estimates, and I think we touched on that before. I'm not expecting, and only take, unfortunately, my advice for that, massive changes in those. The thing to remember, though, is the life insurance is set and it stays the same, and you do not need to pay more premiums on them. Okay, so that's really important. That just goes in place, and then you set and forget it. No more payments or anything required. You can transfer the ownership. That's after you turn it into insurance or before. So that's important. If you're non-resident, you must take cash. Now, we had a really good question prior, and to be honest, I'm going to have to ask specifically with the company and go into this person's details. But if you're coming back to New Zealand, I think it'll depend if you're a New Zealand citizen and if you can use a New Zealand address. But we'll have to talk on a case by case. I think we'll have to let the company know your specific situation and say, if you're wanting to take the life insurance, then we'll have to make an argument for you as going to be a New Zealand resident. So, of course, of the 26,000 policy owners, they're all around the world. Okay, you can surrender the life cover, but you will not get more. So this is once you've taken the life cover. In the future, can you turn that back into cash? Now, their policy the information they provided says they could, but what's happened is they are not allowing you to take any more than what the cash amount surrendered was that bought the life insurance in the future. So not the best option, I would argue, because actually life insurance, as you get closer to death, becomes more valuable, and because there's more likelihood of claiming. So I would try and encourage you to make a really clear decision now, not get caught in having to surrender the life insurance in the future. However, life insurance not impossible to get at any age, so we might be better to get you life insurance elsewhere and look at that for you as well. So it's still a plan B if required. Okay, understand the default options. If you do nothing, a whole of life policy, it turns into life insurance. Okay, so that's really important. If you need the cash now, you're a skier, and you do nothing with this form and don't vote, then you don't get the cash. If it's an endowment policy, so you were to get the cash in the future at some time, but keep the life, you will only get cash. So you won't have life insurance unless you do something. Okay. I will encourage everyone to actually send in the information just for speed of processing and making sure of fairness, as opposed to just doing nothing. Please don't do that. I think it just will make the whole process much smoother and better value for everyone if everyone sends it in. And I've touched on there is a terminal illness benefit. I think I got to 7:34, Rebecca. I think I got it into half an hour when we published 45 minutes. I will just see if I can have a look at the slides. Did I miss anything from your perspective, Rebecca?
Sorry, just unmute myself. No, as an outsider, that all made really good sense to me. Just some other thoughts I had in terms of your estate planning. It isn't one size fits all. And if you've got life insurance policies, they're really useful tools for families who don't always fit the mold. If it's people with blended families, people with age differences in their relationships, um, estates which aren't where it's just not where it's not right for estates to be divided equally, or if you don't have the assets to fairly and equitably divide your estate, life insurance policies are really useful tools. So if you've already got this one in place, and did you say that you no longer have to pay policies anymore?
No, it's what they call a paid up premium. So
Oh,
they've used the
premium.
cash value that the policy's got in it to pay for term life for the rest of it.
Oh,
Yeah.
that's been, yeah. So I mean that if it's something that where it would be a useful tool for you, then don't underestimate that. Um, so, and also important in terms of the values, if you're not aware of how an estate works, if you have an asset that's over $15,000, in order to deal with that asset, you need to apply to the High Court for a grant of administration. When you have a will, that it is probate and is hopefully relatively easy. If you don't have a will, it's dealt with under the intestacy laws, and I won't go into it, but it's a lot more difficult than if you have a will. But that key figure there that you have to be aware of is $15,000. So if your policies or your cash at your date of your death is over 15,000 and it's not owned jointly, then it's really important that you've got a will in place to be able to deal with it. And you've got the right person appointed by you to deal with it as well.
So Rebecca, while I've still got you, just a question I seen come through. If you have a trust,
Mm-hmm.
um, how should you deal with the policy um, in relation to that trust?
I mean, it's a very wide question. If it's owned by the trust, I guess the question is, for what benefit is it being used and whose life is it ensuring? But otherwise, when that person whose life it is ensuring passes away, then it will go in to inform part of the trust assets and dealt with under the terms of the trust. So if your policy is owned by a trust, it's important to understand who the beneficiaries of the trust are, who the trustees are, so and what the long-term plans are for the trust, so that it is managed appropriately. And the same with the cash. If you take the cash, it will become part of the trust assets and have to be dealt with under the terms of the trust.
Excellent. And I think that's probably worth getting advice on as to whether it's
Mm-hmm.
better to be in the trust or outside of the trust.
Mm-hmm.
And no doubt you do a lot of work in that area as to whether the trust is still appropriate because there has been a lot of changes in those trust laws, has there not?
Yeah, absolutely. In 2020, new trust laws came in, which increase the obligations on trustees to manage their trust properly. Also brought in some rules about disclosing information to the beneficiaries of trusts, which understandably so put a lot of people, made them uneasy at the thought of having to disclose information to children and grandchildren. So now with a lot of clients, we do go through the exercise of deciding what the purpose of their trust is and whether it's worth keeping, because there is increased compliance, and there's increased obligations. And I'm sure a lot of you are also aware there's also increased of compliance from financial institutes. So if you want to set up a bank account or do anything, you have to jump through lots of hoops for anti-money laundering laws and identity and verifying everyone. So the compliance on trusts are increasing, and I'm finding a lot of clients are just saying, "Look, it's no longer worth it for me." And that's an exercise that if you do have a trust, I encourage you to do not just once, but on a regular basis to make sure it's still meeting all the um, all the purpose that you set it up for.
Rebecca, people are no doubt thinking, oh, that sounds like a good idea. I should really do that as part of this exercise. But,
Mm.
they're probably also, and I'm sorry to say it, thinking, oh no, lawyers, they're $10,000 an hour. Could you, if I'm sitting here and I've got a foundation life policy and maybe I don't have a will, or maybe I've got a trust and I need to review, can you explain how it would work? What do I do? I send you an email and I say, Rebecca, I think I want you to help me. What do you tell me how much it would cost beforehand? How does that work?
Yeah, absolutely. So, well, we very much have not set fees, but a very set estimate of cost that we provide, based on, whether you've got a relatively simple family and simple instructions. But as you can imagine, some wills do get quite complicated. But once we've spoken with a client, we can work out where they sit in that range. And I can tell you right now that paying for a will up front, a good will up front, is much cheaper than having a no will or a badly drawn up will. I've
I've
seen,
seen that. Yeah, I say to people, I say, would you rather pay $1,000 for your will
yeah,
now, or have your kids pay $100,000
yeah,
each on legal fees
absolutely.
fighting over it? Yeah,
Absolutely.
yeah.
And homemade wills. I've seen some that I joke, not to be insensitive, but look like an exam test because every single part of it failed, in one way or another. So it's really is, wills and estate planning is complicated. It's not one size fits all. And I said to a client today, the best inheritance you can give your kids is peace of mind. Because it's not just the legal costs when you're dealing with estate disputes or estate issues, it's the stress and the grief, and everything, that you don't want to leave your children either. So yeah, absolutely. Just email us and we can have a look at your wills, and powers of attorney are really important now as well, or your trust. Yeah.
Brilliant. Okay, just another question. How can we decrease our premiums but still have sufficient cover? Well, that's with this, if you've got a foundation life policy, the good news is your premium will stop. You won't have to pay any more. If you've got traditional life insurance, that's about getting the cover in the right places. And again, that's very personalized relative to your health, your insurer. Um, a lifetime advisor would meet with you at lifetime's expense if you're one of our clients, and possibly even if you're not, just to make sure you've got the right situation there. Does life insurance get cheaper the older you get? No way. No, the reverse. Obviously, the more likely to pay it out. One final one, because I see we're actually with questions getting up to the end. Um, uh, Finding out whether I need the money or not. Yeah, and sorry for the merciless plug. A financial plan is always your best way to find out what your retirement is going to cost you. And I know there's a lot of guides out there and rough numbers. I'm really reluctant to do that because everyone's circumstances are different. I have clients that retire on $200,000 saved, and I've got some that save on 20 million. So everyone has a different outcome and have different desires. So we are really here at Lifetime, especially to work with all clients and make sure that they have additional support through their retirement. And again, like the will thing, so much better to do it ahead of time. You can meet with us if you're an existing client, then obviously we can discuss an offer for you. But for people new to Lifetime, and I know there is a few on these clients, we charge nothing for our first meeting. We just get to know you and see if you want to proceed. And if we proceed with a financial plan, that can cost from $500 to $1,000. But we may also receive some payment from other sources, but we would disclose that to you and maybe offset the cost of that plan. But it just, as we always say, starts with a conversation. Just get in touch and we'll see if we can help. So that brings us perfectly to 7:43. Rebecca, thank you so much for your time.
Okay.
You're always so good at covering these subjects in a simple, clear way, and I appreciate all the help you give to our clients.
I'm happy to help.
Excellent. Okay, then, thank you very much for attending, and look forward to your call in the future.